So, you think you've got a classic investment showdown on your hands? IGL versus MGL. Two absolute giants in gas distribution. But hold on, there's a twist here, and it's going to change the way you see this entire battle.
And it all starts with this question. Let me ask you, and be honest, are the tools you're using to pick stocks the right ones? Because I'll tell you, when you're analyzing certain companies, the standard playbook, well, it just might lead you completely off a cliff.
And here's why. This quote really nails it. When you're dealing with something like a utilities company, the usual numbers you look at, they just don't paint the full picture. Not even close. This is exactly where a lot of smart people get it wrong.
Okay, let's get into it. It's a tale of two titans. In this corner, we've got Indraprastha Gas Limited. You probably know them as IGL. And in the other, Mahanagar Gas Limited, or MGL.
So you've got IGL, which you can think of as this aggressive empire builder. I mean, it's a huge joint venture backed by GAIL, BPCL, and the Delhi government, and its whole game is expansion, expansion, expansion across the Delhi NCR. Then you have MGL. They're the focused fortress king. They absolutely dominate the super dense, super valuable Mumbai market. So right off the bat, you see two completely different game plans. And if you want to get a sense of IGL's sheer scale, just look at this number. 819 CNG stations. That's not just a network, it's a sprawling empire, a massive footprint built for one thing, growth. Now, let's flip over to MGL. Over 280 stations, which, is still a big deal. But you can immediately see the difference, right? This isn't a fight between two equal-sized players. It's the focused, dense powerhouse versus the giant, sprawling empire.
All right, let's get to the main event. Round one, the financial face-off. We're going to do what most analysts do first. We're going to judge them purely by the numbers.
Okay, so take a look at this. At first glance, this seems like a total knockout. We're looking at the numbers for fiscal year 2025. Revenue growth? Check. MGL. Operating margin? Whoa, MGL by a landslide. Return on equity? Return on capital employed? MGL again. And hey, it even looks cheaper with a lower PE ratio. I mean, it looks like MGL is just running away with it.
So, case closed, right? An easy win for MGL. You'd pack up your bags and call it a day? But not so fast. This is where the plot thickens, big time. So let's talk about the real rulebook. Because that first scorecard, it wasn't just incomplete, it was flat out misleading. To really understand what's going on, you have to throw out the old rules and use a totally different lens.
And here it is, the key to the whole puzzle. It's something called APM gas. APM is just a fancy term for administered price mechanism. All you really need to know is that it's super cheap, government-subsidized gas. But here's the kicker. In October 2024, the government cut that cheap supply by a whopping 21%. That one move, that single regulatory change, threw a massive wrench into everything and completely scrambled the numbers we just saw. And what happens when your cheap supply gets cut? Well, you're forced to go out and buy more expensive gas on the open market. Both IGL and MGL had to do this, and bam, their costs shot up. That's what absolutely crushed their short-term profits. And that is why the first scorecard looked the way it did. So if the old way is broken, what's the better way? Well, here's the new toolkit. Step 1. Forget just looking at revenue, you've got to track sales volume. Prices can be weird and regulated, but volume tells you what's really happening. Step 2. Analyze the network scale and density. That's the real competitive moat. Step 3, and this is crucial, you have to keep an eye on regulatory changes, like that APM gas cut. And finally, Step 4, look at their potential for growth. How much more of the market can they actually capture?
Okay, here we go. The final verdict and the big lesson. It's time for round 2. But now we're playing with the right set of rules. All right, check this out. This is the real investment scorecard. So yes, financial health and valuation, those points still go to MGL. It's a solid, well-run company. But now look at what happens when we factor in our new rules. Scale and network, that's an undeniable win for IGL's massive reach. Growth potential, IGL hands down. They have way more room to expand. Shareholder returns, IGL takes it. And what about risk? Well, because IGL is spread out over a larger area, it's actually less risky. The whole picture has completely inverted.
And so here's the final verdict. When we score it the right way, IGL takes the win. 4 points to MGL's 2. A total reversal from where we started.
So, why the flip? It's because IGL's real strength isn't in this quarter's profit margin. It's in something much more powerful and long-lasting. Its gigantic network, its diversified operations, and its huge runway for growth. These are advantages that are incredibly hard for anyone else to copy.
And this all boils down to the single most important lesson from this whole exercise. It's not about memorizing a bunch of formulas or frameworks. The real skill, the one that truly matters, is knowing which framework to pull out of your toolbox for the right job. It's about knowing when to break the rules.
So I'll leave you with this question. We've seen how this works for gas utilities. But what about other industries? Think about it. Banking, biotech, software. Which of them are you maybe looking at with the wrong set of rules? That's something worth thinking about.